Everything you know about trading is a lie. You have been taught to draw support and resistance lines, wait for bounces, and pray the market follows your trend line. Do you know why it doesn't work? Because the big players, the ones moving billions, don't care about your line. They care about efficiencies. Today I'm gonna talk to you about the FVGs, the footprints of smart money. This is the footprints the big institutions leave behind, and once you see it, you'll never look at chart the same way again, and you will understand some different and interesting things. Look at this. Retail traders see a trend line, they buy the support, and what happens? The price dips lower, indicates their stop losses, and then goes up. And do you know why it happens? Because of fair value gap and imbalance. It happens when the price moves so aggressively that the market doesn't have time to match orders. It's a vacuum, and the market, the algorithm, it always comes back to the vacuum. And if you are trading FVG, you're a dumb stupid person. So now let's talk about the fair value gap, how to find it, how to define it, how to trade from it. So it is the base formation of fair value gap. We need to see the one candle which grabs the liquidity, and it is a higher high, lower high. And after that the three candles movement of forming of our FVG, and after that the big correction, big impulsive correction, which left a huge price gap after it. For example, like in this situation, this big candle is a fair value gap. So now it's looked correctly, and what we can see here, the deep movement after that, the liquidity grab, and it is the main factor of entering into a deal. Now we need to define the zone of FVG. It is not our main candle. It is the previous and next candle after that, and you need to move your rectangle to by its shadow, like that, from the lowest point from the highest end. It is a bearish fair value gap, and in the bullish fair value gap it looks the same way, but where you place FVG from the highest point to the lowest, from the lowest point to the highest, and here you place from the highest point to the lowest. And what happens when the price get to the fair value gap? The institutions reaccumulate all their positions, they bring the price to the zones, to the best zone when all orders were skipped, and after that grab all the positions by this price, where reverse this movement, and the price gets the reaction like on this example. So the best way to open deals from the FVG is of course waiting for liquidity grabs. For example, here the price grabs the liquidity and get reversed. After that it's left behind the liquidity pool which are gonna be grabbed by the price, and fair value gap is a very good factor to enter a deal. It is a good confirmation factor. So the deal you are gonna place from the beginning of FVG zone, it is the most safest way to don't skip the deal. You can place your stop loss in different ways. At the edge of your FVG, it is the most risky way to place your stop loss. The most safest way is above your FVG candle or above it is previous candle, but the risk reward ratio are gonna be lower. And the stop loss you need to place as the liquidity pool which are gonna be grabbed first. For example, it can be like that or like that. And I'm gonna teach you one trick, is entering from the 50% of our FVG. You can take the Fibonacci grid and define the 50%. It is the best way to place your deal from the 50%, because the price has a great change to grab the 50% of the FVG, feel it, and after that you can get the position. And by this method you get a good risk reward ratio, better risk reward ratio, and get a better deal. Look, I know we sound simple, but the devil is in the details. We need to know which FVGs are valid and which ones are just noises. I don't want you to waste nothing guessing like I did. I created a smart money cheat sheet, a one-page PDF, but what shows you the exact criteria for a high win rate. With this PDF I'm gonna show you how to define the best FVG, because where can be formed in one movement can be a lot of FVGs, and I know how to define the best from which you need to trade. Click the link in the description, grab the sheet and join the community. I'm posting my real-time setups there every single day. If you want the edge, go get it now. Okay, you have a cheat sheet. Now here's the execution. You wait for the price to return to the gap. Most pros don't enter at the start of the gap. We enter at the 30% equilibrium mark. Why? Because it offers the best risk to reward ratio. Your stop losses goes below the entire sequence. That's it. It's math, not magic. You stop gambling and start trading the order flow. So now I'm gonna show you some examples on the real chart. For example, let's go to the BTC, the 1 day time frame. And for example, here we can see that red movement, the wrapping of liquidity, and after that the FVG are formed. So here we can see a downtrend FVG and open deal from that already, because the price breaks the structure. About the breaking of structure I'm gonna teach you in the next lessons. Drop your likes. And after the liquidity grab, which are formed here, the price grabs all the liquidity, fulfilled our FVG and drops down. So here we can get a very good deal. And how to trade the sideways movement by the using of FVG, I'm gonna teach you and show in the next videos. So here we can see a great thing. The candles like that are FVG and order blocks on the higher time frames, and from that we can trade. And of course, after grabbing of all this liquidity, all this liquidity which are formed here and not grabbed, after the grabbing and forming our new FVG, we are 100% need to enter from it, because all the factors are matched and it is high change successful deal. So go to the backtest mode on the trading view and see some FVG by yourself, trade from them. But only in the backtest you need to spend a lot of time on the backtest before the real trading. So here we can see the price formed our first FVG, but we don't get a really good deal, and if we trade from that, we are gonna be liquidated. But here and here we are see the another FVGs from which you can trade and enter a very good profitable deal. But you need to know how to determine the right FVG from which you need to trade. So for that, follow my Telegram channel where I'm gonna drop all the materials. If this video finally made the light bulb go off, smash that subscribe button. We are building the most disciplined trading community on YouTube. Check the pinned comment, grab the cheat sheet, and I will see you on the inside. What do you want me to break down next? Order blocks or liquidity sweeps? Let me know in the comments.